Good morning, Trader First Year. This is the 3/29/2021 morning forecast. Markets are implying a move of 1.26% up or down on the S&P 500. Markets have realized a move of 1.07% up or down. The difference between what market makers are implying and what has been realized has tightened. The spread widened to 293 basis points. The put-call gamma imbalance has been reset but is likely to favor more call buying. However, a tightening spread decreases left tail risk and reduces the potential spike in realized volatility. Realized volatility has decreased recently below 18. This is favorable for wider and larger moves up or down on the indices. I expect a decreasing trend over the second quarter during April, May, and June. The current market environment is favorable for traders looking to sell convexity via short straddles and strangles, call overriding, put rights, and short vol strategies to capture alpha on the indices and individual stocks. Bond market volatility has decreased, limiting spillover effects. The MOVE index hovers around 65 to 68, or movements of 4 basis points daily in Treasury yields. However, economic growth upgrades and rising inflation expectations without rising inflation or economic growth are pushing up real yields, which is creating a equity long duration valuation conflict and raising discount rates. The S&P is expected to move close to 1.34% up or down this week, which means the S&P could rise 14% or fall 10% above its 200-day moving average, which is 3,534.85. The S&P traded slightly above its 50-day moving average, which is 3,873.72 last week. Full-year S&P earnings are expected to total 175 per share. At current prices, this puts the S&P at 22 times earnings, which equates to an earnings yield of 4.5% and an inflation-adjusted real earnings yield of 1.93, using the 5-year TIPS break-even for inflation, which is currently at 2.57. Analysts are anticipating earnings in 2022 of 201 per share. At current prices, this puts the S&P forward earnings for 2022 at 19.6 times, or a yield of 5.1%, and an inflation-adjusted yield of 2.53%. Forecasters are rushing to upgrade nominal and real growth expectations for the full year in 2021. The highest number of private forecasters and those from Federal Open Market Committee members are close to 7% on a real basis. If this rate of growth is realized, it would add $1.3 trillion of real output to the U.S. economy. The coronavirus subtracted 3.5% of real economic output from the U.S. economy in 2020. In 2021, the U.S. economy would need to grow at least 3.62% to break even on a real basis. For the first quarter of 2021, current estimates of nominal growth are $300 billion and real economic output of $130 billion. This forecast has been surpassed following the release of last week's income report. The U.S. is on pace to generate a little under $500 billion of economic growth and output in the first quarter. At the current pace, if it held through the full year, would generate close to $3 trillion of economic output. While this is exciting, I do not expect this pace to remain sustainable or likely to culminate in those gains. However, I do believe a nominal gain of 1.5 trillion to 2.2 trillion in economic nominal output is possible in 2021. Full-year economic estimates have increased significantly following the passage of stimulus. The median forecast was anticipating close to $1.2 trillion in nominal growth and $800 billion in real economic output for 2021. The current pace of nominal growth, as of this morning, would generate a total of $2.9 trillion for 2021, which would be broken down by personal consumption of $2.03 trillion, gross private domestic investment of $519 billion, net exports of goods and services subtracting $89 billion, government consumption expenditures, and gross investment of $523 billion. A major acceleration in growth is positioning the U.S. to capture more than one-third of global economic output in 2021. Economists continue to place the highest expectations for growth in the second quarter of 2021. Investment banking professionals are forecasting nominal growth of $400 billion and real output of $240 billion for the second quarter. This is a substantial amount of spending on goods and services, which may face downside risk if there are any delays in COVID vaccinations or rollouts. Under these assumptions, we would need $50 to $60 billion of spending on personal consumption expenditure in April, May, and June. I think we could see nominal growth in the second quarter of $700 billion to $600 billion, and real output is likely between $375 billion and $310 billion. For March, there's a strong possibility the $1,400 stimulus checks increase consumption similar to economic data in January 2021, which recorded a $487 billion nominal gain in personal consumption expenditure. It is also equally likely to engender significantly higher personal savings rates, we may temporarily eclipse the 20% savings rate experienced early in 2020. The higher U.S. savings rate is helping fund larger savings in public sector finances and reduces substantially reliance on foreigners' savings. I do worry about the pace of growth of private investment in 2021. Gross private investment grew at a double-digit clip at the start of the decade, but slowed considerably in the later stages. If this trend of sluggish private investment growth persists, it could weigh heavily on long-term potential growth via a reduction in capital deepening, which may fail to stimulate substantial increases in worker productivity at a faster rate. This is also a broader and more global risk with savings and investment. Due to the virus, the U.S. stimulus is likely to engender larger current account deficits. This is partly reflected in stimulus in creditor large surplus economies, which have very limited few domestic investments to make despite higher domestic rates of savings in the U.S. The February non-farm payroll report was strong and robust. However, the trend has been weak non-farm payroll growth and elevated numbers of Americans receiving some form of unemployment assistance, which indicates large swaths of slack in the labor market. Private forecast is anticipating payroll growth between 270,000 and 500,000 per month, which equates to 3.2 million and 6 million additions to full-year U.S. payrolls. This key economic indicator is likely to pressure growth in the first half of 2021. The relatively slow growth of the U.S. population, along with a substantial rise in the number of workers not in the labor force, has shrunk the size of the current available labor pool. In 2020, the U.S. lost a total of 9.7 million jobs, or a loss of 6% of the labor force. To break even this year, the U.S. would need employment growth of 6.6%. However, the recent agreement on $1.9 trillion in deficit spending is a significant tailwind to nominal growth in the second half of 2021 and the first half of 2022. This should increase aggregate demand, which should foster higher employment gains, but this assumes that virus cases come down substantially by April, May, June, and pandemic flare-ups lessen. This has led some market observers to anticipate economic overheating, which is favorable for upside risk in inflation. I believe these fears are statistically unfounded. However, I do not disagree with rising inflation as a potential risk in the short term. The recent increase in nominal Treasury yields and 5-year break-evens on TIPS, which are Treasury inflation-protected securities, towards 2.57% is transitory and likely reflecting anticipated increases in energy prices and base effects. The Federal Reserve typically subtracts 40 basis points from the break-even inflation rate, which would mean inflation expectations are currently anchored around the 2% inflation averaging metric. Following the passage of stimulus, larger fiscal savings increases capital inflows to finance very large twin deficits, which should put upward pressure on the U.S. dollar and downward pressure on corporate and government bond yields. The current rise in yields and increase in growth expectations will likely favor a stronger U.S. dollar in the first half of 2021. This is also likely to put some additional pressure on higher real yields if growth and inflation increases are realized. Although potentially weaker inflation data than consensus estimates should allow real yields to remain negative. Dollar appreciation also dampens import commodity-driven inflation and should lessen temporary transitory base effects. Inflationists and inflation fear mongers engaging in scare tactics are likely to be proven wrong. However, inflation base effects are expected to be short-term. There will be transitory spike in headline inflation data from March, April, and May. The impact on core PCE is expected to be limited. Market expectations are split, but I expect the Federal Reserve will look through these spikes. Political risk have diminished in the first quarter due to reconciliation, but it has increased in the second half of 2021 and the first half of 2022, which may pose risks to much needed investment spending on infrastructure, human capital, research, and development. So I view it in the medium term as tilted to the upside due to potential gridlock. However, there is a possibility for another round of reconciliation in the 2022 budget, combined with the removal of the filibuster rules in the Senate. This could pave the way for easier passage of additional investment-led spending, which is much needed to raise the U.S. long-term potential growth rate. Although, due to political isolation, this increases the potential for lone wolf domestic terrorism. Vaccine distribution is priced into Q3 2021, but distribution obstacles have increased and efficacy for herd immunity will be closely watched. Redefining herd immunity may become the norm. So instead of a fully vaccinated population of 90%, we may accept a different goalpost for full vaccination. Perhaps it drops between 70% to 75%. Details are currently unknown. The market is currently pricing in an additional 6.54% move up or down by June 18th. The S&P could trade potentially as high as 4,163.29 and as low as 3,670.61 by June 18th. The VIX is expected to move 6.49%. The VIX is currently priced at 20.08. The VIX price range is 21.38 to 18.85. The skew index is extremely elevated, which indicates market participants are paying up for catastrophic protection, which are 2 sigma events. Stocks continue to offer investors the highest real return. The nominal yield on equities is 4.5%, while the nominal yield on 10-year treasuries is hovering around 1.63%. Real yields on all tenors of government bonds at the shorter end of the belly and belly of the curve are decisively negative, but real yields at the longer tenors above 20 years have moved into positive territory. Real yields on U.S. equities remain strongly positive. Disclaimer: with realized volatility rising above 12, there is a larger risk of systematic highly leveraged short vol strategies like equity vol targeting, trend following, and risk parity position for a sell-off and reduction in market exposure. The potential for a much larger delayed sell-off of 4% to 5% has diminished. We are much more likely to see a fall in realized and implied volatility and a gradual melt-up in asset prices. The April-May VIX contracts at 21 and 23 are fairly priced. In fact, they may now be overpriced given the new economic outlook. Passage of fiscal stimulus should juice the start of a new long-term economic cycle, which favors a continued fall in realized volatility. I am temporarily moving against a large rise in implied and realized volatility. However, I have been wrong before, but sell-offs will give investors great opportunity to buy the dip. Traders should focus on cyclical sectors which tend to outperform at the start of a new economic cycle. For example, being long financials, industrials, metals, mining, oil, gas, consumer discretionary, and technology. Thanks for listening, and thanks for following.